All right, welcome to my video on price risk. Now again, like always, be an active learner. Take notes along the way. That way you can come back and reference the information. Plus, the activity will keep you better engaged. All right, let's talk about this idea of price risk. What is this all about? Now, in this video, I want to introduce the concept. Some other videos are going to go into a lot more details. But the idea with price risk is it's really a time risk. Now, there's lots of other risk that we have in agriculture. If you're a producer of any crop or any other product similar, weather is going to be something you're going to deal with. If you operate in a greenhouse setting where you can control the environment, then you've got other costs that are going to come at you, but you're going to be dependent on suppliers to get you those products. So we always have production risk. That's just part of the nature of our business. But price risk is something else, meaning that we have potential to think we're going to get a certain price for our product that we produce, and we don't. Or we think we're going to buy a certain product for a certain price, and we're not able to get it. So there's lots of different ways we can look at price risk, but it is a special type of risk that producers have. And so that's what we're focusing on today. And time is something that really interferes with that. The other thing that we need to make sure we pay attention to in price risk is consequences. Usually these are called unintended consequences, but we have our best laid plans in the market. And after we get involved and we get in the process, time is going to be what we're going to manage and deal with, and then the consequences that come at us in the market probably aren't going to be planned for at all. So how do you manage price risk? We all are risk takers in our industry, but managing this is something we can do. So let's kind of dive into some of the ideas. Now, when we talk about price risk, it really makes sense to think about the supply chain. So in agriculture, how can we describe this process that we get into in ag? And you may be involved in the entire process or just a part of this, but let's look. We're always going to have some phase of our industry. Let me change colors a bit. We're always going to have some phase of our industry that I would put in the production stage. So this is a farmer growing his commodity. This is a rancher producing calves for the next stage. This is a feed yard feeding animals to get optimal weight gain to then move them to the next system. So we've got a production process, and you are going to be involved in that in some way. After this production process, we are going to have a processing stage. Now in this processing stage, we're refining the product. So we'll do an example here in a second, but you've always got this, I'm a producer making the product, and you might exchange product to someone else where they become the processor, or you're integrated through this supply chain. In this case, we would be looking at a, let's say we're looking at our vertical connection. But as we go through our supply chain, we are going to be have a processing stage. After this processing stage, we are going to have some kind of a retail stage where the product finally gets used for its original intent. And there's lots of different ways that we can look at these in examples. So like, for example, production stage would be a farmer, and that farmer is going to produce something like a corn product. And as the farmer raises the corn, it's going to get put into some process where it's going to be milled into products that can then be used in all kinds of processes, and they are going to input out of that a product. And in this product, it finally gets utilized. So the idea, to be simple, is you've got a production stage, a processing stage, and a retail stage. And that connects back to price risk, because all along the way, we have price risk. And so what does this price risk look like? And it could be at any stage, or it could be at all across the stage. In other words, you could be a farmer that grows your own corn, makes your own, let's just say, tortilla chips, that you then turn around and brand as a product and put that out there in the marketplace. All along the way, or in each individual section, there really are two participants in the market that deal with price risk. And I'm going to come over here in my notes, and I'm going to talk about what each one of those are. And the first one is the buyer. So in your notes, do the same. And their next one that you are going to be trying to deal with is if you are the seller. So what are the price risk for the buyer and the seller? And they're actually pretty easy. They're interesting to look at because they change quite a bit. The buyer, what is a buyer worried about? If I am a feed mill buyer and I buy corn to put in my feed rations, let's say I make a high-end equine feed and I utilize corn as one of my inputs and my ingredients to go into the product. Or another example that's more current, a good friend of mine is part of an equine nutrition group and they've got an equine feed. Where they get their alfalfa to put into that feed product is very important to them. And when they go to buy that product, they're after the certain quality. Once again, that's a production risk that's always there. The price risk is a buyer is worried that the price is going to do what with them? You would know. The price is going to increase. That is their concern. So their goal, what's their goal? Their goal from a price standpoint is to get it as high, as low as they can. Sorry, not high, low. Their concern is that price might go up, so their goal is to get price low. So any buyer is going to always be out there looking to see how can I manage price and get it as low as I can. Therefore, I have a lower cost and I can manage my product layer. Price risk, their worry is price goes up. All right, what about the seller? They're a completely different opposite focus. What is their concern? Their concern is that the price would go down, so that is their concern. Now, as we have that concern that price goes down, then let's talk about their goal. Their goal would be to get price to go which way? Up. So we have these two conflicting views, but yet all over this supply chain, we've got to have buyers and we've got to have sellers making a deal that they're both happy with. And so how do they get happy with this? How do they bridge this gap in here that we call price analysis? So I'm drawing this graphic here. You can draw along with me. And the answer is going to be some sort of a contract. And a contract is where they get together and agree upon different parts of this contract. One of those is price risk, kind of our main concern. But what are the four parts of every contract? Well, the first one I'm going to start with is going to be price. The second one I'm going to go with is going to be quality. Write these down with me. The third part of the contract is going to be time, like a delivery. That kind of connects to our time area. And then the other part of this is the quantity. So I'm going to abbreviate that a bit, quantity. So in a contract, you typically always negotiate these four things, or that's the attributes that must exist. And so in this contract, if the buyer can say to any person or any entity throughout the supply chain, I want to buy this product from you. For example, my buddy with the feed business and the equine industry, I want to buy alfalfa hay product from you. It's got to be of a certain quality, and I need it at a certain time, and it's got to be a certain quantity that I need. And if I negotiate price, their goal is to get the price down. Now the seller, their goal of selling their alfalfa, again, they're going to talk about quality, time, and quantity they can supply. But it's going to be to try to get that price to go up. But somehow these have to meet and they make a deal, and that's through a contract. Now, there's two types of contracts, and this opens up more discussion for later. But the two types of a contracts are typically called a forward contract. And when I write forward contract on my notes here, really I'm going to kind of put in here, this is the normal contract. Because anytime we talk about let's make a deal, let's write up a contract, you and I are going to be actually trading the commodity and the contract and the money all in the normal market. And I'm going to go ahead and just call that the normal market. That's also called a forward contract. Now, there's another way that the buyer and seller can deal with price risk, and it opens up a lot more topics to talk about later. But instead of doing a real forward contract, you know what else I'm going to put in here? I'm going to put this is a cash contract. Let's put that. In fact, let's put a little dollar sign by it because this is going to be the real money here. All right, this real money here is where we're buying and selling and we're trading contracts. It's the normal thing we're used to talking about. Back to my friend's equine business again. If they are looking to buy alfalfa product to make into alfalfa cubes as a horse feed, then the seller is going to be selling them the alfalfa, and they got to ship it to them, and they got to make all those arrangements, and they will negotiate all four of these things, if not maybe more, but those are the four basic ones. That's called a forward contract, normal contract, cash contract. Hopefully that sinks in. All right, what's the other kind of contract that would exist? And this is called a futures contract. And a futures contract is a publicly traded. They don't really have to know each other anymore. A forward contract, we're typically going to have to know. The seller and the buyer are going to have to get together and make a deal. A futures contract is a whole nother type of contract. All four of these are parts of it. But this futures contract is going to be where they can trade in, is what I like to say, or they can trade out of the contract. It opens up a whole nother realm. But that's for another story or another video. So again, let's review a bit of the things important. Price risk is a function of time and the consequences that the market throws at us. We have lots of other risks, but price risk is one. It actually is all throughout the whole supply chain. And in the supply chain, who has this price risk? The buyers and the sellers. And they have different goals, but how do they manage this? If they just wait and the buyers just say, well, I'll just see what I can buy it for when I need it. And if the sellers say, I'll just see what I can sell it for when I'm ready, they are wide open to price risk, and that is an inappropriate way to manage their business. They are going to go ahead and try to deal with it, and it's going to happen through contracts. These contracts represent a period of time. Sometimes these contracts will be 3 months out in the future, maybe a month out in the future. They can really be a long way out in the future, a year ahead of time. But a contract is how producers deal with price risk, buyer or seller side, either one. It's got 4 attributes, make sure you know those. And there is 2 types, main types, a forward, cash, real, normal contract. And then there's something called the futures contract, which that is traded on something called the CME Group. CME Group, I think, .com is the site. But if you go to CMEgroup.com, you will see the futures market. And again, that's for another video. Hopefully this video helps, though, explain the first important part is what is price risk and who is involved. Thanks.